Hi, everyone, and welcome to another episode of UBS Road to the Election and Election Watch series. Today, I'm really excited to welcome the guest that I have in the studio, Rich Clarida, who is currently PIMCO's Global Economic Advisor and formerly the 21st Vice Chair of the Federal Reserve, ranging in the years from 2018 to 2022. So lots to get into on the show today with Rich. First of all, nice to have you in the studio with me.
Glad to be back.
Glad to have you back.
Yeah.
It's been a little while.
It has.
And since the last time I saw you in person, you went from your job at PIMCO to work at the Fed for 4 years.
Yeah.
Now you're back at the PIMCO game and also teaching at Columbia University. So lots going on in your life and lots happening in this election cycle, which we just talked about. It's been kind of topsy-turvy. We've had to throw out the cards a few times and start over.
Tear up the script.
That's right, exactly, and see where we land. So I think the big question that we're all looking at, and it's even outside of the election, is the state of the economy now. As we're sitting here, we had a bit of volatility in the last week and a half. The jobs numbers, the unemployment rate rose a little bit, and clearly, I'm sure you can't take that Fed hat off. You're constantly looking at data, like your former coworker Jay Powell is doing.
Yeah.
So give us your view on the economy as we sit here and as we're heading into the election.
Look, I'll cut to the chase. The economy's in a good place. My former colleagues probably won't use the term soft landing, but that's certainly what they're aiming for. The Olympic analogy, they want to stick that landing.
Right.
And 2 years ago, inflation was 7, 8, 9%. It's now running at 2 point something. Labor market has held up pretty well. I think more recently some softening, and that's now on their radar screen. But our baseline view is growth downshifts to about trend, and inflation's on a glide path to that 2% target, with the Fed beginning to cut rates in the fall.
Yeah. I know as we're sitting here, we don't have the latest CPI numbers just yet.
Not yet.
But the producer price index came out today, a little bit less than last month. And so that seems to be moving in a good direction.
Oh, sure. I think, look, when the Fed paused now 13 months ago in July of last year, it really was a pause. Inflation was still too darn high. It was running at 4 something. Really, since then, the inflation data has improved. We had a couple of bad months in the spring, which caused them to pull back on telegraphing the cuts. But the disinflation has resumed. It's pretty broad-based. It's showing up wage disinflation in the PPI. It's actually even just starting to show up in some of that rental data. So I think that is giving them confidence that they can begin to start normalizing rates.
Right. And it's interesting because we here at UBS, our economist in the Chief Investment Office expects between September and December 100 basis points of cuts. And I think other economists have increased their forecast. But in your opinion, do you think that if the Fed seemingly comes out and aggressively, maybe that's a strong word, but they cut in September or October, but things right before the election, that may be a sign that they're trying to make a statement? Or is it, from when you're sitting in that chair, you have to make the decision for the moment?
Really, you do. The Fed as an institution has been around for 100 years. The modern Fed certainly really values its independence to set interest rates. My good friend and colleague Libby Cantrell and I went back and looked at this, and what we found, what's interesting is in the last 40 plus years, the Fed has typically been raising or lowering rates in presidential election years, not because they want to be part of the cycle, it's just that's where the economy is. I think that if they do cut in September, which is what we expect, they'll have ample justification. Inflation is falling. Labor market is starting to slow. And I think the Powell Fed will make the decision they need to make based on the data, not on the election calendar.
Very good. I like hearing that because it's obviously, there's a lot of people who say, well, the Fed can't come out and cut rates. It'll look like they're taking sides or what have you. So on the flip side, something that we've been hearing on the campaign trail is the question, maybe, of the independence of the Fed. Now, we know that the Fed is an independent body. It's not related to either of the parties. But on so far the campaign trail, Donald Trump has said he should be involved in making decisions with the Fed. Meanwhile, just recently, Vice President Harris said she would never interfere. Obviously, I have my own biases on what this should be. What are your thoughts on all of that?
Well, the Fed has what we call instrument independence, but the Fed is a creation of Congress. So there is a statute that's been amended that says the Fed has a job of using monetary policy to achieve price stability and maximum employment. The Congress doesn't say raise or lower rates or buy or sell 10-year treasuries, but the goals of the Fed and its responsibilities are in statute. The Fed takes that very seriously. Look, folks express opinions on central banks. You know, we saw that earlier in the Fed's history. I think that we're in a world where the Fed will guard that institutional independence, notwithstanding some folks who may want to be opining on policy.
Right.
So they'll just keep on doing what they're doing.
Everyone's an expert, right?
Yeah.
Until they actually sit in the room that you've sat in for 4 years and see what's at stake.
Yeah.
Yeah. So, you know, we talk about monetary policy in the Fed all day, and that's what you did for your job, and still talk about it. But there's still fiscal policy.
Oh, yeah.
You know, can the government, you know, lower taxes if need be, if we go into a recession, for example?
Yeah.
Not that we're calling for one,
Right.
but in an example, yes, the government can say, all right, we're going to lower taxes for now to help stimulate the economy.
Yeah.
And there's that, you know, do monetary and fiscal policy necessarily have to work together? You were at the Fed during and like before and during and after COVID. So you really saw everything.
Oh, yeah.
What does that look like today?
Well, I think there are very few things that people in Washington agree on, but one of them is that the U.S. is on an unsustainable fiscal path. Mm-hmm. So no one seriously argues that we can keep running budget deficits of $2 trillion a year. The debt to GDP ratio is 100% of GDP. According to the CBO, under current law, it's going to 150% of GDP. So the real question is not if, but when there's a political agreement in Washington to put the U.S. on a sustainable fiscal path. At PIMCO, we believe that could be some ways down the road. There are a couple reasons for that. One is what our founder Bill Gross referred to years ago as the U.S. Treasury is the cleanest dirty shirt in the sovereign debt market. You know, every morning you wake up in the summer, you got to wear something to work. So you just take the cleanest dirty shirt. Because if you sell treasuries, you got to buy something else. Mm-hmm. And it's not really there aren't a lot of real alternatives now. The other thing I would say is that neither party right now, as far as I can tell, is really running on a platform of fiscal consolidation. You know, earlier in my career, I vividly remember the bond market vigilantes, you know, Jim Carville's famous line to Bill Clinton, he wanted to come back reincarnated as a bond investor. And the bond market vigilantes, let me, to your viewers, are not extinct. They're in hibernation. They occasionally do wake up. We saw that about a year ago after the Fitch downgrade. But the most likely scenario is the politics in Washington, regardless of the election outcome, are going to really drive people to kick that fiscal can down the road for at least the foreseeable future. Yeah. But certainly not because it's sustainable, because the U.S. is on an unsustainable path for sure.
Yeah, I mean, certainly the men and women of Congress have a lot of work to do, and whoever's sitting in the desk in the Oval Office in a couple of months will certainly have their work cut out for them as well. Thanks, Rich. I also wanted to ask you, because, you know, bringing it back to your Fed hat, we've had a number of central banks start to cut rates this year. Yeah. The European Central Bank, Bank of England, Bank of Canada, except for Bank of Japan, which has been a zero interest rate policy for 17 years. They're going the other way. Yeah. But everybody else is cutting, and we have yet to on the U.S. side, but we expect that Jay Powell will likely start cutting. Do you think that this is the right path? Do you think that we're on the right path and that the moves that these other banks are making are the right moves for right now?
Sure. I think that the way it's, obviously, as Jay Powell himself has said, you know, the first rate adjustment, the first rate cut is consequential because the Fed would not cut rates thinking that one and done. So they do want to make a decision. However, I also think that that the ultimate pace of rate adjustments is going to depend on the economic data. You know, the Fed laid out in its projections, and we'll get new projections in September, but the Fed in the June projections laid out a pretty attractive, what I would call, they won't call a soft landing scenario, where they start cutting rates and then rate cuts basically gradually decline more or less at the pace that inflation is falling down to to target. That's one scenario. Another scenario is they cut more rapidly if the economy slows. But I do think that this will be a cycle, most likely, where the Fed will give some indication, say in September if they cut, but they're not going to map out the entire game plan because they themselves don't know the pace or even necessarily the destination till they see more data. They are more alert, as they should be, to labor market conditions. 2 years ago when they started hiking in the spring of 2022, I made the point that they really weren't all that data dependent. The only two data points they needed were inflation was 7 or 8% and the Fed funds rate was 0.
Yeah.
So they knew rates were going up for a pretty wide range of inflation. But in the last year, they've become more data dependent, and now they acknowledge in the FOMC statement, which we saw at the July meeting, that the committee is now attentive to both inflation risk and labor market conditions, which is a good place to be.
Absolutely. And looks at the end of the day, when Powell gets up there and does those press conferences, he sticks to the story. He speaks for the FOMC. And they didn't overreact. I think there were a lot of people calling for an emergency cut after the vote. And I could see it already, the wincing that you're like, oh, it's just such a...
Well, maybe a little bit color for your audience.
Please,
so I was there in March of 2020 when we had 2 cuts ahead of a scheduled meeting. And so we prefer to refer to those as unscheduled meetings, not emergency meetings. So within the Fed, that was an unscheduled meeting. But yes, and a potential risk of that, and we confronted a bit of this, is if you surprise markets by cutting ahead of a scheduled meeting, the reaction can be, and we saw this in March of 2020, wow, things must be really bad. What do they know that we don't know?
Right.
So I was always skeptical, a week or so ago when we had the market volatility, that just because the carry trade unwound and the VIX spiked, that would be sufficient to get them to move. And I think since then we've more or less seen the indications are that that's not something they're entertaining now.
That's right.
Which I think is a good call.
I certainly not being the expert in the room, you are, but I agree with you. I think making an emergency or what did you call it? An unscheduled meeting probably would have been the cart before the horse in that scenario. Seems like I think you can safely say you think Powell's doing a pretty decent job at what he's got in front of him then.
Well, sure. And, just, again, another Olympic analogy. A lot of sports, you get graded on performance and degree of difficulty. And it's been navigating a global pandemic and a collapse of, people forget, maybe if I can just remind us, because we're all looking at today's headlines, but in March of 2020 and in April, in those 2 months, 22 million people lost their jobs. We wiped out 10 years of employment gains in 2 months. Mm-hmm. Appropriately, folks didn't feel like going to work, and if folks could afford not to. It was not at all clear there would ever be vaccines. And if you're in that room and you're thinking, how do we run a financial system if companies don't have revenues?
Yeah.
How do they make debt service payments? It is quite a frightening prospect. And so without apology, the Powell Fed was all in, and I think history will regard that as the Fed at its best. So I was proud to be part of that group that made those calls.
Yeah, I'm sure there's going to be a book in your future at some point.
We'll see. Certainly have a lot of fond memories that I might put down in writing. Yeah,
absolutely. And Powell's got 2 more years left in his term, so he's still got the work cut out for him. But anyway, Rich, thanks so much for
thank you.
coming through. Great to have you.
Let's not wait another 8 or 9 years to do it again.
I agree with that. We'll get you back in sooner. Great to see you.
Thank you.
Thank you, Rich Clarida, again from PIMCO. They're a global economic advisor and former vice chair for the Federal Reserve. And thank you all for watching today. There's a lot more information on this series and all of the Election Watch content at our website, ubs.com/Election Watch. All the episodes in this series are there as well. And if you'd like to continue this conversation, we please encourage you, make sure you're reaching out to your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone. We'll see you soon.